for those questions. Welcome, everyone. Can everyone hear me? Can you just type what state you're coming in from? We're here in New York City. We'll give it a few more minutes before we start. Judy, maybe we could post that that question on the webinar. All right, Judy, I'm going to start, okay? So everyone, welcome to the How Can Daycare Owners Save at Least $10,000 in Taxes webinar. That phrase you will learn today is literally a fact. Judy, did you post the question?
Yes, it's gone.
Okay, all right. So a little bit about myself. We're going to go through the pleasantries fairly quickly because we have a lot to cover, and I want to have the time to spend on substance rather than this type of situation. But my name is David. I'm the Daycare Accounting Pro. We've been servicing the daycare industry or the childcare industry for over a decade now. Over the past years, we've had success stories after success stories. This is one of them. This is Nakia Whitson, owner of Baniac Babies. I believe the first year she started with us, we saved her about $35,000 in taxes. And at the end of the, within the next 24 hours, we'll make sure that the recording is sent out to everyone that registered. Okay, so one of the first things we have to address is the elephant in the room. Over the past 2 years, 80% of the daycares that we have spoken to have not chosen a proper business entity. And we have to understand how critical that is. When you don't choose the proper business entity, you end up paying what is called self-employment tax. So I know that many daycare owners have opened LLCs, but no one has told you that there are tax consequences when you open an LLC. And when we have these in-depth consultations, we find out that you have an LLC, but you haven't made an election as to how you want to be taxed. Therefore, you're paying these sums of easily over 5 figures in taxes. So yesterday, I had a conversation with a client that for 2022, her tax bill was over $200,000. And when I uncovered her books, her records, her tax return, I realized that it was because she was filing as a Schedule C, being a sole proprietor of an LLC corporation. So in the next 20 minutes, I'm going to explain a couple of things. I'm going to show you the pros and cons of the different business entities. I'm going to show you the importance of choosing the proper business entity for your business, how to take advantage of depreciation and other tax strategies, and how to add your children to payroll. So what are the common pitfalls that childcare owners are making? I understand that you guys wear 15 different hats. You're the jack of all trades. You're the therapist, you're the counselor, you're the owner, you're at times the janitor, the collection agency, and all these situations come into play when you're dealing with your business. Because you're overwhelmed and stressed, most of the business owners find that financial decisions tend to be postponed for a later date, which never comes. That frustration leads us to pay additional taxes that we don't have to. So one of the things that we're going to discuss is commingling of personal expenses with business accounts. If you're a W-2 sole proprietor, it's prohibited by law. I've had too many conversations with childcare owners that are filing as a sole proprietor on their 1040 and they're paying themselves a W-2. It's prohibited by law. You have to be careful with that. Because in fact, the IRS may not tell you anything, but the fact that you're doing that, you're paying double tax. You're paying tax on your income, on your net income, and also on your W-2. Many childcare owners do not have an effective bookkeeping process. So like many of you, your focus is on what you do best, and that's to provide a nurturing educational experience for the kids in your care. Your job as a business owner does not entail to be a jack of all trades. I'm sure none of you got into this business to talk about accounting and bookkeeping. Now, over the past decade, we've noticed that too many childcare bosses are paying too much in taxes. And many are frustrated with their bookkeeping and payroll. They have no idea how to fix it. So why are so many daycare owners paying too much in tax? And we're going to start with this. I need you guys to pay attention here. It's a lot of information. Many of you, when you started a business or you went from a sole proprietor and you opened an LLC, whoever you did it with, whether it was an attorney, whether it was a tax accountant, whether you want a legal Zoom, no one told you what the tax consequences are. And when you file an LLC and it's a single member LLC, the IRS default is a sole proprietor. A sole proprietor is subject to self-employment tax, which is 15.3% of your net income when you file your 1040 with a Schedule C. We're going to go over a case study in which I'm going to show you how that translates on a tax return, and you're going to get a bird's eye view of that tax return. If you're a multi-member LLC, meaning two or more owners, your default is a partnership. Partnerships are also subject to self-employment tax at the 15.3% level. And if you're married and you are a partnership in the business, typically you file a Schedule C, which again goes back to the self-employment tax. If you're different owners and you're not married, you file a 1065 partnership tax return. The business tax return doesn't pay tax, but the pass-through income that we put on your personal tax return, and I'll show you that on the tax return, pays self-employment tax. C corporations, usually for small business owners, I wouldn't recommend that. C corporations pay 21% business taxes, and any dividends that the owner takes, they pay taxes on their personal tax return, thereby called the double taxation. We only recommend C corporations for any business that's making over $10 million and has over 200 employees. Now, the S Corp does not pay tax. I'm going to repeat that again. The S corporation does not pay tax. Now, you can be a single member LLC, you could be a partnership, or you could be a corporation, and you could be considered an S corp. So the LLC does not change. The only thing we're changing is how we're filing our tax return. And limited liabilities, if you Google disregarded entity, you're going to get a limited liability. Disregarded entity is basically, it's insignificant. It's a zero to the left. The IRS has no care for it. All they want to know is how we're going to tax you. Now, note that changing your tax classification, and by changing tax classification, I mean going from a sole proprietor. Remember, the LLC does not change. We're just changing the tax document that we're filing. By going from a sole proprietor to an LLC, it does not change your registration or your EIN. The only thing we're electing when we make that change is how we want to be taxed. Julia, can we put up the second question? And let me know how many are LLCs. So we're going to go over this case study. So we have, I know there are probably men in the attendees, but we're using a client by the name of Mary Poppins. She's a single owner of AAA Daycare LLC. Mary files as a head of household with her 15-year-old son, Freddy Krueger. That was Judy's idea. On her 2022 tax return, she filed as a sole proprietor with a Schedule C. Her daycare is located anywhere in the U.S. Her current enrollment is 40 kids with an average fee of $250. Her annual revenue is $500,000. Her expenses, including payroll, are $350. So she's left with $150 of net income. Now I'm going to share my screen. I'm going to show you a tax return, and we're going to review this. So here's Mary Poppins. She's filing head of household. And she has one dependent, Freddy Krueger, age 15. Now, Mary Poppins, on her tax return, her 1040 individual tax return, because she's a single member LLC and is a sole proprietor, she files what we call a Schedule C, which is a profit and loss from business. Here's AAA Daycare. Here's her tax ID. So she generated $500,000 of income. That's the gross income. And we have total expenses of $350,000, which means that she has a net profit of $150,000. If you recall, I mentioned before that when you file a Schedule C as a sole proprietor, you're subject to self-employment tax at 15.3%. So what's the tax? The self-employment tax? So self-employment tax on $150,000 is $21,000 of tax. This tax is in addition to your income tax. Now we're going to go to your tax return, where we reconcile the tax return. So here we have Mary Poppins, head of household with Freddy Krueger, and we have $150,000 of total income. She gets some deductions here. So her taxable income is $96,000. Tax is applied at this level, at the taxable income level. So from her $150,000, 96 of it is taxable. So what's the tax on $96,000? It's $15,000. So $15,000 in tax. Because her child is under 17, she qualifies for the child tax credit of $2,000. That offsets tax, making her tax $13,000. However, we have to add the $21,000 of self-employment tax, making her total tax $34,000. So we're taking income tax and we're adding self-employment tax, and we have a total of $34,000. You guys can keep a note of that. $34,000 on $150,000 of total income. Now I'm going to show you a business tax return for an S Corp. We're going to go to AAA. We're no longer filing a Schedule C. As an S Corp, we file an 1120S, which is an income tax return for an S Corporation. Here we have AAA Daycare LLC. The LLC registration does not change. Here we have their tax ID. The tax ID does not change. Now we have total income of $500,000. We're comparing apples to apples here. And we have $350,000 of total deductions, expenses, leaving an ordinary income of $150,000. You guys have to pay attention to this. See what it says here, line 25, amount owed, 0. It's because an S Corp tax return, an S Corporation, when they file a tax return, does not pay tax. The S Corporation, it was called a pass-through entity, meaning that the income, whether it's a profit or loss, passes through from the business to the individual owner. Now, if you're an individual owner like Mary Poppins, you get what we call a K1, which is the shareholder incomes, the owner's share of income from AAA to Mary Poppins. Since Mary Poppins is 100% owner of AAA Daycare, 100% of the income will be allocated to her. So she will receive what is called the K1 in the amount of $150,000, which is her total income from the business. Now we file the tax return. We pay 0 tax. Now we have to take that K1, which is her total income, and place it on her personal tax return where she will be taxed at her rate. Hopefully you guys are following along. Now we're going to go to a personal tax return. So now we have Mary Poppins. Since we no longer file a Schedule C, this becomes obsolete. So we're going to remove these numbers. Everything is 0. And now we're going to add Mary Poppins K1 on the tax return, which is her total income from the business. So now we're going to add $150,000 here. The first thing I'm going to show you, we just added total income, 150. But if you notice, self-employment tax is 0. Why? Because the S Corp does not pay self-employment tax. It doesn't pay tax at all. That income you pay on your personal tax return. But since Mary Poppins filed as an S Corp, she is not subject to self-employment tax. So how does that translate on the tax return? So now we have $150,000 of total income. Apples to apples. After deductions, her taxable income is $130,000. Tax will be applied at this level. So what's the tax on $130,000? $23,680. She gets the $2,000 credit for her son, 15-year-old son Freddie, minus 23, leaves $21,680 of tax. But if you notice, see this self-employment tax here? This line is zero. She does not pay self-employment tax because she filed an 1120S tax return for an S corporation. So her total tax is $21,000. So we just went from being a sole proprietor, single member, multi-member LLC, filing a Schedule C. We just changed paying $34,000 in tax. We made that form obsolete. We decided to file an 1120S. We filed that tax return, and just that one strategy, that one change, saved us $13,000 in tax. Just that one strategy, you save $13,000 in tax. Now, what are the pros and cons of an S corp? The first thing is that since the IRS recognizes that moving from a sole proprietor to an S corp, you're avoiding, not evading, avoiding self-employment tax, they require the owner to take a reasonable wage in the form of a W-2. So now, as an S corp owner, you will be required to add yourself to payroll. And if you're making $500,000, I'm sure you're doing payroll. All you have to do is add your name to a payroll and take a reasonable wage. Reasonable wage depends on your role in the business, your region where you reside, and the comparables of what your role is in the business opposed to other businesses. Now, the IRS is hiring 87,000 auditors. And there are many S corp owners that are not taking a W-2. And for those 87,000 auditors, that is the low-hanging fruit. So you have to be careful with that. Now, we have an algorithm where we can determine based where your business is, what your revenue is, and what your role is in the company. We can determine what a reasonable wage is. Now, the words reasonable wage are very vague. The IRS lives on that vagueness. So we have to make sure that all our I's are dotted and T's are crossed. So if by chance you ever get audited, you have the research and the knowledge, say, hey, this is a reasonable wage based on these factors. Now, I know a lot of TikTokers, YouTubers, and accountants telling you that there's so many other ways that you can, deductions that you can use to pay less tax. I'm telling you that to significantly reduce your taxes, there are more important things to look at than just deductions. So with tax strategists, like I tell my clients, the IRS has two rules. There's a rule for the people that know, and there's a rule for the people that don't know. You want to be on the hand that knows. Now, what are the common missed strategies that daycare owners are currently missing out on? One is depreciation. So this is kind of a sensitive topic. Many accountants are now using depreciation for the benefit of their clients. So right now, during this fourth quarter, we're doing a lot of fourth quarter adjustments to our clients who we expect to have a huge net income. And we're trying to figure out ways to strategize so that we can take certain measures to lower that tax when it's time to do the tax return. And one of them is through depreciation. So if you need to purchase equipment, whether it's a Ford Transit 15-passenger van, because you do pickup and drop-offs, or you go to the supermarket, whether you need to purchase a playground, or you made any capital improvements to your building in 2023, you can take a 80% bonus depreciation. And I'm going to explain that on the tax return. Now, this is a very popular deduction for business owners. And unfortunately, for every year now with the new tax law, it's going to go down by 20% till it hits zero in 2027. But I'm going to show you how that translates on the tax return. So here's depreciation. So here we have $150,000 net income, correct? Now we're going to go to depreciation. We purchased a 2021 Ford Transit 15 passenger. We placed it in service. We bought it in, this is 2022, so I'm going to use 01/01/2022. It's a bus. It cost us $50,000. So we can depreciate it over a course of recovery period 5 years, and every year we'll get a $10,000 deduction. Or in 2022, this asset qualified for 100% depreciation. So it will take yes, 100% depreciation. Now that 50,000 just cut our net income by 50. Now we just went from 150,000 net income, and because we depreciated that vehicle or that asset, we're down to $100,000. We saved roughly about $7,500 in tax just by using that one strategy. And many business owners are not taking advantage of it. Another missed strategy, prepay your vendors in 2024. So if you're using Brightwheel, ProCare, iCare, professional services, we have clients that prepay the entire year of 2024 in December, and they get that deduction in the current year. And I'll show you how that works. Some, depending on what the net incomes, we could strategize to prepay some of the mortgage on the business asset. So they own the building where the daycare is housed, and we could prepay some of that and get those deductions. So let's say we're here. Let's go back to this tax return. Let's say we paid, let's do professional services. You sometimes pay, let's say 20,000 professional service in advance. In subscriptions, what I care, that's another, say another $10,000. So they made prepayments of $30,000 in 2023 to vendors that they know are going to be used in 2024. So you just prepay, you're going to get the deduction. They're going to get the income on there, but that's their problem. You're going to get now a $30,000 deduction, and now you're down your net income to $70,000. With two strategies, we just cut our tax in half. Now I'm going to go back to that tax return once I'm done here and show you the difference. What's the next strategy? So we have children on payroll. I'm amazed that there are not more childcare owners placing their children, especially when they're under 17, on payroll. Why? If you have I'm going to use myself as an example. I have 3 children. I put them on payroll. Now, if they're grown now, but if they were under 17, the kids pay 0 taxes. So if you paid them for 2023, you could pay up to $13,850 per child and pay 0 taxes. And you still get the deduction. Just make sure you have some type of written job description. So I had a client, she has a 2-month-old, actually, 2-year-old. So I added on payroll. First I asked, how do you feel about putting a picture of your daughter on your website? Not a problem. Okay. Add her, put her on the website. All of a sudden, that child became the talent. And because that child is the talent, she's entitled to a wage. Okay, $13,850. Direct deposit that money into the business owner's account. Now, because you paid the $13,000, you're able to deduct it. Now let's go here. Let's go back to the tax return, the business tax return. Let's go to wages. So let's say you paid an additional $13,850. And that's one child. You can have, if you have 3 children, you're taking a $41,000 deduction. $41,000 deduction, which is cash in your account, because that $41,000 is going to be direct deposited into your personal account. You're not going to give a 5-year-old $13,000. It goes direct into your account. And I'll give you a strategy that you can use with that money later. You take that money, and that is a deduction. You just have to make sure you have a job description for each child. But let's take $13,850. We just added one child, Freddy Krueger, on payroll to do filing in the office. So we pay him $13,850 a year. Now that brings our income down to $56,000. But that $13,850 went into our account for the benefit of the child. So now, even though you paid the child $13,850, you can still claim that child on your tax return. If you live in New York, you need to see me for the explanation on this. You get the payroll deduction. And here's the sweet part. Because Freddy Krueger has earned income, earned is a key word, earned income, he's allowed to open a Roth IRA for each child, and you can contribute $6,500 for 2023. Now, everyone lately on TikTok is talking about generational wealth. Here's a way to build that. So how do you do that? Go to your bank, open a Roth IRA. First, you have to put them on payroll. So from the $13,000 that you direct deposited into your account, at the end of the year, you're going to take $6,500 and place it in that Roth IRA. Now, why the Roth? Because the Roth is tax-free growth, meaning that if you place $6,500 and next year a miracle happens, you purchase a stock, ABC stock, and it shot up, and the account value is $1 million. And by the time Freddie is able to retire, he has in that stock $10 million. You started with $6,500. You invested it. It's now worth $10 million in a Roth IRA. Freddie can withdraw $10 million from that account and pay 0 tax. I'm going to repeat that again. The growth on a Roth IRA is tax-free. So when you set to retire, you pull that money out, you pay 0 in taxes. So not only did you get the deduction, not only are you able to claim the child on your tax return, you're building generational wealth. And in turn, you made some money for yourself because the $6,500 minus the $13,000 went into your pocket. It's a win-win scenario. So this is a bonus strategy that I'm sharing because I noticed that many accountants are not using this. So let's say on 500,000, so a daycare was doing $500,000 is spending roughly around $15,000, between $15,000 and $20,000 on food. Hopefully that's a fair assumption. It's about that, $15,000 to $20,000 in food. However, you're able, this per diem meal rates comes from the IRS. What they're saying is, if you have a child where you serve breakfast, which is $1.40, you serve lunch, which is $2.63, and you serve a snack, which is 0.78, you're able to deduct $4.81 per child per day. So remember earlier on the case study, Mary Poppins had 40 kids. So we're going to multiply 481, which is the per diem rate, times 40 kids, times 5 days a week, times 52. She's able to deduct not the actual $20,000 in food expense. She's allowed to deduct $50,000. So let's go back to this return here. So let's say food allowance per diem, 50,000. The ordinary income is $6,000. We just went from 150. We used 3 or 4 strategies, and we went down to 6,100. But let's remove this. I want to show a higher number. So now, Mary Poppins, without the food allowance, she has an ordinary business income of $56,000. 56,150. So now she's going to get a K1 for $56,000. Now let's go to the personal tax return. We're going to make this 56,150. Now this is total income. Deductions, her taxable income is now 36,000. The tax on 36,000 is 4,100 bucks. She gets the $2,000 deduction for the child tax credit. Her total tax is $2,000. No self-employment tax because she's an S corp. We took depreciation on the vehicle that she needed to purchase. We placed Freddy Krueger on payroll. And with those 3 strategies, we're able to lower that tax from a Schedule C of, it would have been less. Schedule C of 150, we just went from 150 to 56. So we saved roughly $22,000 in tax. So the original slide said, how can you save $10,000 in tax? I'll show you how you can save more than that. But you have to apply these strategies, and they're critical. But the main thing here is, as an S corp, your benefits are greater than a sole proprietor. And you're able to take more deductions, and you're able to do more things to pay less tax. So now, we're very big here on transformations. We believe in business transformations. We want to take it from an in-home to a center. If you have a center, we want to take it to multiple locations. It can be done, but we have to use the bookkeeping and taxes as a tool to get us there. Many of you are not taking vacations because you feel you have to be the be-all for everything in your business. You have to wear the 15 different hats. But can you imagine if you had your finances in order, how much time could you be spending with your family? How many vacations can you be going? And I recommend that you take vacations constantly because you need to clear your mind. And before we end, remind me, if I don't, I have to tell you a personal story. You need to live the life that you want. You need to be happy. You need to be free. Do whatever you like. You have a business that's producing income, but yet you're working in the business. It's time now, when you reach certain levels, 500,000 is one. You have to start thinking, opening your mind, and start working on the business. And I'll explain what I mean by that. whether we help clients, whether they're in-home groups, whether they're a center, where they have multiple locations, just to give them peace of mind, because we have to get to that point. So I had a personal issue where I realized that I was the bottleneck of the business. The business wasn't growing because of me. And for the daycare industry, every conversation I have, I notice that it's because of the owner. Because you want to be the accountant, you want to be the bookkeeper, you want to do the payroll, you want to open, you want to close, you have to do the cleaning, you have to handle staff issues, and all of those hats that you wearing are taking you away from working on the business and getting that peace of mind. Now, when I realized that I was the bottleneck of my business and I made that switch, everything started to change. I don't do my own bookkeeping. It makes no sense for me to do my own bookkeeping. The time I'm spending on my books and records, I could spend on a webinar providing education information to you guys. That's going to find its way so you can transform your business. So we have a current offer for, I guess, until then, for the next 48 hours. So if you want to become an S corp, the IRS gives you the first 75 days of the year to file to become an S corp. We're in December, basically. We're beyond that. If you file a S corp election now, they would apply to 2024. However, there's a specific tax law that will give us the ability to go retro back, even though we're late. You can go retro back to January 1st of 2023, and you'll be considered an S corp for 2023, even though you're not right now. However, you have to file that before the end of the year. So we file it before the end of the year for 2023, you will be considered an S corp. Otherwise, you'll go into 2024, and for 2023, you'll be subject to the self-employment tax. So for everyone on the webinar who registered, we're offering a 20% discount on the S corp election, and it's valid for 48 hours. Our normal rate is $495. We're offering that now for $395. Next to that, you'll see a scheduled appointment. Our consultations are free. You can scan that QR code and schedule an appointment directly with us.
David, you want to answer a couple of questions before we go?
Regarding this, shoot. Read them off to me.
Yeah. There's Maribel asked, am I in Ohio? I have a small daycare, which is family daycare, which is out of my home. How can I apply this to me?
Okay. So you can apply some of the strategies. Like you could put your child on payroll. You could do some depreciation. You can't do the S corp. Now, typically, we don't recommend for a business to go from a sole proprietor to an S corp until they're making about $75,000 in net income. That's when we begin to see savings. I hope that answers your question. But if you need additional information, Maribel, if you just schedule a call, we'll be happy to help you.
And then Megan asked, can you use the child on payroll method for a sole proprietor?
Yes, you can. Just make sure you have a written job description, whatever that may be.
Okay. Those are the questions as of now. So now I'm gonna
So this is our location. If you need to get in touch with us, you can just email us here. Yeah, Judy put up another polling question. This is our address. We're located in New York City, and we service all 50 states. But to schedule an appointment, just take a picture of this QR code. Now, I'm going to be kind of blunt here. Between now and January, we will be available. After January 15th, it's going to be extremely difficult to get a hold of me. because we give priority to our clients. And that's when we ramp up with tax work and taxes and payroll. So if you need to make an appointment and you want to take advantage of strategies, remember, you have to do it before the end of the year. Because once you make any payments in 2024, they apply for 2024. Any other questions? Judy, do you know how many
Megan, are you asking for the job description as a model for daycare advertising? Not sure what Megan is asking there, but Shayla asked, so if you are in an in-home daycare netting more than 75,000, can you do an S corp?
That depends. If you're an LLC, yes. If you just have a business certificate from the county or the local clerk, no, you're considered a sole proprietor. In order to do that, you will have to create an LLC and elect to be taxed as an S corp. But if you need further guidance, I'll be happy to provide it. That was Sheila, right? Is there any way we can get her on can you open up a line? So I want to ask you a question.
Okay. Let's see if I can find her. Okay, Shayla, you can now talk if you'd like to ask a question.
So yes, I am already an LLC, so that means that I just need to do what to make it an S corp.
You have to file Form 2553. However, you have to cite specific tax law if you want to be considered an S corp for 2023. Otherwise, if you submit it now, the IRS will use it towards 2024.
Okay.
But yes, you can. What's your net income?
Probably about 85,000.
Okay, let me show you what that would look like. Just self-employment tax. Get rid of this. 285. Your self-employment tax is 12 grand.
Okay.
And that's in addition to any income. Now, there's some situations where you may, because you have, let's say, multiple kids, you have 3 kids, if you have 3 children under 18, you just using an example.
No, I don't have any children under 18 anymore.
Oh, so you're filing single?
It's myself and my husband.
So you file married. Okay, so yeah, you're gonna have to add that to any other tax, income tax, but the self-employment tax in 85 is $12,000. So you can save that by becoming an S corp.
So how do I determine what a reasonable wage is for my area?
Okay, you're in what state?
Texas?
Texas. Okay, so for Texas, we recommend around 8% of gross. What's your gross?
About 115.
Your gross is 115 and your net is 85. You're doing really good.
Thank you.
115 times 8%. 9 grand
Per year?
per year.
Wow. So how does the IRS consider that a reasonable wage if, say, you went to a local daycare center and figured out who their director wage would be around, I don't know, maybe 50, 60,000?
It depends on your gross income.
Oh,
Now, right. The algorithm is based on your gross income. So if you're making, let's say, 500,000, you would be at 40, and that's reasonable. So if you tell me, and there's a good point where you brought up any other place, you get a director. So when I have clients ask me, what's a reasonable wage? I'm telling them, listen, if you were to leave your job and you had to hire someone to do what you're doing right now, how much would you have to pay them? And whatever that number that pops into your head, that's a reasonable wage. However, there are other factors that we have to take into consideration. So we have to take consideration the region that you're in, which is Texas, no state tax. We also have to consider the role that you have. So there are some owners that play a critical role. I have a client that's an owner of one, but he just owns the daycare. He's not physically dealing with the daily operations. So he's making over $1 million. So if he's making over $1 million, I tell him just to take $25,000 W-2, which is not close to 8%. Why? Because his role is different from probably yours. He just invested the money and he has the people employed, and he once a week gives a call, they give him an update. So his role is a lot less than yours. So therefore, even though he's making $1 million, 25,000 is a reasonable W-2 for the year.
Okay. So when you're doing your accounting though, and you have your profits, when you pull the profits from the business, do you do that as like an owner's draw?
That's correct. So
Okay.
remember, this net income, you're paying tax on. So let's say, for example, at the end of the year, you have $85,000 of your net, and that's $85,000 is in your bank account. You could literally pull that $85,000, and that's yours. You'll just pay tax because you're paying tax on that 85.
Okay.
So that's totally your money. You can pull it out, do whatever you like. So let's say throughout the course of the year, you pulled $40,000 minus 85. You can pull another $45,000 if you wish. But the fact that the 40,000 that you pulled out, it's already factored into this net profit.
Okay.
Because it's an owner's draw. And since you're the sole proprietor, you're the owner. So whether you used it or you don't, you're still paying tax in the same price.
Okay. So if I did that with an S corp, what would, on these numbers, what would be my total taxes owed?
All right, Shayla, can we, I've got a couple more questions.
Oh, absolutely.
I think some of
Sheila,
these
just
were.
schedule an appointment and I'll give you, the 20 minutes that we have.
Okay.
And what's the phone number or email to schedule that appointment?
You have a phone?
You have a phone, you can scan this,
Yes. Okay.
and it'll take you straight to a calendar.
Got it. Thank you so much.
You're welcome.
Okay. All right, Darlene, can you unmute and ask your question?
Yes, I have a question, and I thank you so much for taking the time to call my name. I'm loving what I'm hearing. I'm loving every bit of it, but I have a question. I turned my business, which is a home daycare. I have a total of, I'm licensed for 12 children. I have a total of staff of 3. And the 3, which includes myself. I make the third party. So I had this Zoom teaching as what I'm hearing now, and they insisted that I become incorporated. But listening to what I'm hearing now, I'm totally amazed. I'm like, oh my gosh, I just paid that money for Incorp when I could have did S Corp. So my
Okay,
question
wait,
is this: what's the problem? What am I doing?
wait, no. Okay, Darlene, let me explain something.
Yes.
So an LLC is a type of business entity. An INC is a type of business entity. The S Corp is just how you file your taxes. It has nothing to do with the business entity. So the fact that you incorporate it is very good, because as a sole proprietor with a business license, you cannot file as an S Corp. But as an incorporated, you can. You just have to file the proper paperwork with the IRS. What state are you in?
I'm in Illinois.
Okay, so you file filing the proper paperwork with the IRS, and you'll be considered an S corp. When did you do that? In what year?
I did that in March of 23.
Oh, so then did you didn't file for the S corp in March, did you?
No, I did not. I became Inc. It was just regular home daycare.
Okay, so whether you become INC
And that also
corporation
included myself on payroll
as an Inc., yes.
as an
Now,
Inc.
right. So when you create an incorporation, in your case, your default is a C corporation. Remember what I said before? C corporations are double taxed.
Okay.
Where is it? Okay, here. So when you create an INC, the default is C corp. The IRS will always default to the highest tax for them. So, so they're going to default to a C corp, which is known for double taxation. So let's say you run a business and you have $100,000 of net income, you're going to pay 21% on tax on that. So the business tax return pays tax. The S corp does not pay tax. But as a
Okay.
C corp that you are right now, you're going to pay tax on the profit, and any money that you took in the form of a distribution or dividend, you will pay tax on your personal tax, thereby
Oh.
double taxation. Yeah, you should do an S corp immediately, if not sooner.
Yes, because I'm seeing, based upon what I'm hearing, I want to be considerate of those who have questions to ask as well. I would just want to make sure that I'm not I'm not setting myself up for a setup. In other words,
In
that's
what
where I
sense?
want to. Yes, I definitely don't want to do that. And
In what
I'm
sense do you mean that?
well, because you said that they're hiring 80 something thousand new for the IRS.
Okay, you don't want to put
And
yourself in the position of an audit.
right,
Well,
exactly.
you're not going to be audited. What you're going to be doing is paying more tax that you shouldn't.
Right. That's another thing. I want to keep the money in my pocket. Not
Exactly.
I don't want to I don't mind being generous, but I don't want to be over generous.
Now, what's your net income?
My net income is like 80,000.
Yeah, you need to do an S corp.
Okay.
Okay,
Yes.
we've got
Thank
about
you.
5 minutes left, Darlene. Thank you. And I have one more person that is on an iPhone. I'm going to say allowed to talk, but I'm not sure of the name here. So, let's see if, there we go.
Thank you. Now I can make your plate. Thank you.
Mhm.
Okay.
I can hear you. Hi.
Hello,
Yes?
Yeah.
my name is Nadesh Gabriel. This is my first time. I would like to ask a question. This is my first time to apply income tax with only me, because I always apply income tax for me and my husband, my daughter. But I would like to apply income tax for my business, family daycare, only me and my daughter. This is my first time.
Okay, well, you're saying you filed a joint tax return and you want to file head of household with you and your daughter?
Yes, for also my business, family daycare, only me for this next year.
Okay, that's a long conversation because if are you currently married?
Yes.
Okay, so we would need to see exactly why do you want to file head of household separate from your husband?
But I would like to apply only me, my daughter, and my business family daycare.
Right,
For
you can
next
do
year.
that. You can do that, but that may not be beneficial for you. So the lowest tax bracket is a married filing joint return. The next is head of household, then single, then married filing separate. Those people that file married filing separate, I just received a return today, have no reason to live because they lose all the credits. And that's the highest tax bracket. So you have to be careful. You need to speak to an accountant. If you want, you just schedule a call. Where is it? Scan this with your phone, take a picture,
Okay,
and you can schedule an appointment.
okay, okay, 1 second.
Anybody else, Judy?
Thank you.
You're welcome. I can't hear you, Judy.
There's Darlene.
Okay, one more question. I can't scan it with my phone because I'm listening to the Zoom with my phone. So,
Okay, well, this is our email address. This is our address and phone number, and
I
we
got it.
will
I
also send you
screenshot it.
a copy of this webinar.
Awesome. Thank you.
Okay.
Okay, that's all we have time for as far as questions. So, thank you, everybody, for.
Wait, wait. Let me see. Wait, hold on. Kayla. Depending on the child description, you're doing filing. If you have a website and your child is young, you can put up a picture on the website, and they're the marketing not manager. They're marketing talent. So there's different ways you have to get creative with these. But as long as they're performing the duty, if you put a picture of your child on the website, that's more than sufficient proof that you have to pay them because they're the talent. If you don't pay them and you put someone else's picture, you got to pay them. So that's suffices that. All right, guys, it has been a pleasure once again. But I forgot to tell you guys why I got into this business. So the reason I got into this business, I asked you, and I'm sure no one answered. They wanted to be an accountant. Is to help. Well, the reason I got into this business is because I had a huge tax bill, huge, and I went back and forth with the IRS. I hired several accountants at different intervals. No one did what they had to do, and finally, I got so frustrated that I dealt with it on my own. I called the IRS. I figured it out, and the last accountant where I engaged, they saw what I did and they offered me a job. So I started working. Then I started noticing. I started with a couple of daycares. Then I started noticing all the issues that daycares were having, and I decided to focus directly on that specific niche. And the reason being is if you were on this side of the desk, on this side of the Zoom call, and you were to hear the horror stories that I hear from daycare owners that are paying $200,000 in taxes, $150,000 in taxes, when I have a client like yesterday, that client that I spoke to, she told me in 2022, she had to pay 200 plus in taxes. And when I showed her another client of mine making more than having a higher income that she currently had, paying $40,000 in taxes, that's $170,000 swing in taxes. So this client that I spoke with yesterday, she's paying more taxes in the amount of $170,000 than a client of mine that's making more money. It's all these type of scenarios that have forced, because I see the need. I don't recall. I didn't see the numbers on what the response was as to why you got into this business. But if you got into the business to educate and nurture, you need someone to help you with your accounting and your bookkeeping. The same way I got into this business for accounting, and I'm helping daycare owners. So these type of situations, I understand that you guys wear all these hats, and sometimes the financial stuff just falls to the side. I had a daycare owner a couple of days ago. She's making over $1.6 million, and she hasn't filed in the last 3 years. That is insane. And I understand that life happens, stuff happens with your business, and you put it to the side and you forget about it. That's why, like I mentioned before, I realized I was the bottleneck and I wasn't allowing the business to grow because of me. You have to do the same. So for those of you that like to read or listen to Audible books, I'm going to put it in the chat, a book that you guys should read. It's called The Effective Executive by Fred Drucker. If you read that book, it will transform your business, because now you're going to begin to realize that there's certain things they should be focusing on, not petty stuff like accounting, bookkeeping, and taxes. Now, that's our job. Like, I cannot go into a daycare, even though I could imagine I could figure it out, but I can't go into a daycare and do what you guys do. And the fact that if I knew as a parent that a daycare owner was going through overwhelming situations and challenges with their financial matters, I know that that individual is stressed. And as a parent, you wouldn't want to leave your child in a place where management is stressed, because that's going to filter through to that. That's why we have to take vacations. That's why we have to have peace of mind. That's why we have to let go and get professional counseling. Not everyone's a professional counselor. Not everyone's a tax strategist. You have to vet, do your research. You guys can look it up. Look me up on the IRS, wherever you want to go. Do your research before you hire someone. Make sure that person is reputable and that they have your best interest at heart. With that, I thank you guys. And hopefully in the next couple of months, we'll do another webinar that's going to bring you added value to your business. Thanks, everyone. So long. Judy, we're out.